You're scrolling through your phone at night and you see it. Your college roommate just posted about their investment portfolio, up 34% this year. They're casually throwing around terms like index funds and compound interest and FIRE, financial independence, retire early, like it's the most obvious thing in the world. The caption says something like, let your money work for you. You keep scrolling. Now it's someone from high school. They just shared an article about paying off their mortgage 7 years early. Big smiling photo in front of their house. Caption, debt-free at 38. Best decision we ever made. And you're lying there in bed, phone in hand, and you've got this mortgage sitting over your head. $480,000, 7% interest. And every month you're writing that check, watching a huge chunk of it disappear into interest. And you're wondering, am I doing this right? Should I be throwing extra money at this thing? Or should I be investing? Am I behind? Are both of those people right? Can they both be right? The financial advice internet will tell you 10 different things. Dave Ramsey says pay off all debt, period, no exceptions. Finance Twitter says mortgages are cheap leverage. Invest everything. Reddit says it depends on your tax bracket. Your coworker says their financial advisor told them something completely different. And meanwhile, you've got a real decision in front of you. You just got a raise, an extra $1,000 a month that wasn't there before. And you genuinely don't know what to do with it. That's what this video is about. We're going to run the actual numbers, not estimates, not ballparks, the real math, on 3 different scenarios. And by the end of this, you're going to have a clear framework for your own situation. I call it the F-squared rule, the Freedom Fund rule. And I'll warn you right now, this video has a few moments where the math is going to surprise you. The obvious answer isn't always the right answer. And the right answer isn't always what you think. My name is Marcus, and I spend a lot of time thinking about the decisions that keep people up at night. The ones where the internet is loud and contradictory, and everyone seems completely certain about completely different things. Quick note before we get into it. Nothing in this video is financial advice. This is purely educational. I'm here to break down the math and the psychology so you can make better informed decisions on your own. All right, let's get into it. Let's establish a realistic scenario so all the math we're about to do is grounded in something real. You just bought a home with a 30-year mortgage. The loan amount is $500,000 at a 7% interest rate, which is pretty close to where rates have been sitting in the current U.S. market. Your monthly payment works out to about $3,327 per month. That's just principal and interest, not property taxes, not insurance, just the pure mortgage payment. Now you've been making these payments for about a year, and then you get that promotion. Congratulations. Your salary bumps up, and suddenly you've got an extra $1,000 per month that you didn't have before. The question, what do you do with it? Do you take that $1,000 and throw it at your mortgage every month as extra principal? Or do you invest it in the stock market? A low-cost index fund, something boring and diversified? This is the exact decision millions of people are wrestling with right now. And most of the advice out there picks a side and ignores the other one. We're not going to do that. Let's start with the investment route. You decide to take that extra $1,000 per month and invest it instead of paying down your mortgage faster. You set up automatic investments into a total stock market index fund starting in month 13, right after that first year. Now, we need to talk about expected returns, because this matters a lot. The S&P 500 has historically returned about 10% annually over long periods. Some years it's up 30%. Other years it's down 20%. But if you average it out over decades, you get somewhere around 10%. To be a bit conservative and accounting for fees, taxes, and the fact that past performance doesn't guarantee future results, let's use 9% as our expected return. So you're investing $1,000 per month at 9% annual returns. And to make this more realistic, let's say every year you bump up that investment amount by 3% to account for raises in cost of living. This is called a step-up contribution, a small annual increase that mirrors how most people's income actually grows over time. If you run those numbers for 29 years, the remaining life of your 30-year mortgage after that first year, your investment account grows to approximately $1,834,000, nearly $1.85 million. That's retirement money. That's financial independence money. That's the number your college roommate with 378 likes is implying they're building toward. At first glance, this seems like the obvious choice. Just invest, let compound interest work, ignore the mortgage, and ride it out for 30 years. But hold on, we haven't looked at the other side yet. And the other side has something that most people completely misunderstand about how mortgages actually work. Before we look at scenario 2, I need to explain something that genuinely surprises most people when they see it for the first time. Because if you don't understand this, you can't understand the full picture. Imagine your $500,000 mortgage as 10 blocks. Each block is $50,000. You make payments for the entire first year, over $39,000 in payments total. So your loan balance should be down to about $450,000, right? You paid off one block? Dead wrong. After one full year of payments, your loan balance is still $496,000. You paid down only $4,000 of principal. The other $35,000 went straight to interest. This is called amortization, and it's how virtually every mortgage in America works. Early years, the vast majority of your monthly payment goes to interest, and only a tiny fraction actually reduces your balance. Let me show you the real numbers from our $500,000 example. In month 1, your $3,327 payment breaks down like this. $2,917 goes to interest, and only $410 goes to principal. That's 88 cents of every dollar going to the bank, not to your balance. In month 12, it's still $2,894 to interest and $433 to principal. Even after 5 full years of payments, you're still paying $2,710 to interest and only $617 to principal. It is not until month 242, more than 20 years into your mortgage, that your payment finally tips to more principal than interest. For 2 decades, the majority of what you pay goes to the bank, not to your equity, not to your net worth, to the bank. This is why lenders love 30-year mortgages. They are extraordinarily profitable, and understanding this is essential to understanding what prepayment actually does. Now let's look at what happens if you take that extra $1,000 per month and apply it directly to your mortgage principal instead of investing it. Here's the thing about prepayment that makes it powerful. Every single dollar you put in as extra principal goes directly to reducing your balance. Unlike your regular monthly payment, where most goes to interest, an extra principal payment is 100% balance reduction. And when you reduce the balance, you reduce the total interest you pay over the life of the loan. Let's run the numbers. You take your $500,000 mortgage at 7% and add an extra $1,000 payment starting in month 13. You also increase that payment by 3% per year, just like we did with investing, to keep the comparison fair. The results are dramatic. Your mortgage, which was supposed to take 30 years, gets paid off in just 16 years and 3 months. You shave nearly 14 years off your mortgage, and the total interest you pay drops from $698,000 all the way down to $318,000. You save $380,000 in interest. At this point, a lot of personal finance content would stop here and declare prepayment the winner. Look, you saved $380,000. Pay off the debt, but that's not the full picture. And stopping there is intellectually dishonest. We have to account for the money you actually spent to achieve this. You made extra payments for 195 months, starting at $1,000 and increasing 3% per year. When you add all of those up, you spent approximately $238,000 in additional payments. So your actual net savings is $380,000 minus $238,000, which equals $142,000. $142,000 in net savings. That's real money, but it's not $1.85 million. Investing wins by a landslide, right? Not yet, because we're still not done. And this is the part of the calculation that most people skip, and it completely changes the picture. Here's what almost every comparison like this gets wrong. When you pay off your mortgage early, you don't just stop. You don't keep living with the $3,327 monthly obligation that no longer exists. That money is freed up, and freed up money gets deployed. So in month 196, when the mortgage is completely paid off, you now have your entire mortgage payment. The original $3,327 plus the extra $1,000 you were putting in. That's $4,327 per month suddenly available to invest. You still have roughly 13 years and 9 months left before we reach the original 30-year mark. That's 165 months. What happens if you invest $4,327 per month for 165 months at the same 9% return? That $4,327 per month grows to approximately $1,186,000. Add back the $142,000 you saved in interest, and your total is $1,328,000. Now let's compare everything side by side. Invest only, $1,834,000. Prepay, then invest, $1,328,000. Investing still wins by about $506,000. That's not nothing. $500,000 is a significant gap. So case closed, right? Just invest everything and ignore the mortgage? Not so fast, because there's a risk hiding in the investing scenario that the spreadsheet doesn't show you. And it's the thing that keeps people up at night way more than debt does. we need to talk about sequence of returns risk. And I want to explain this carefully because most people have never heard of it, and it might be the most important concept in this entire video. The stock market has averaged about 10% over the long term. We've been using 9% to be conservative. But here's the reality. You don't get 9% every year like clockwork. Some years you get 25%, some years you get negative 35%. In the order in which you experience those returns, the sequence matters enormously. Let me give you a real example. If you had started investing $1,000 a month in October 2007, right before the financial crisis hit, and you kept going consistently through 2008 and 2009 and beyond. All of that, your annualized return from October 2007 to October 2015 would have been about 4.5%. Not 9%, not 10%, 4.5%, because you started right before one of the worst crashes in modern history. Now, imagine you started in March 2009 instead, right at the bottom. From March 2009 to March 2017, also an 8-year period, your annualized return would have been over 17%. Same market, same 8 years. Completely different results, purely based on when you started. That is sequence of returns risk, and it's not hypothetical. It happened to real people who made real decisions. Now, here's the thing about mortgage prepayment. There is no sequence of returns risk. None. Zero. The interest rate is locked in. When you pay down principal on a 7% mortgage, you are guaranteed a 7% return on that money. Not approximately 7%, not an average of 7%, exactly 7%. With no volatility, no chance of a bad year, no sequence risk, no waking up in 2009 watching your account be down 40%. Think about what that actually means in today's environment. A guaranteed 7% return is genuinely competitive. High-yield savings accounts are paying 4% to 5%. 10-year treasury bonds are around 4.5%. Corporate bonds might get you 6% if you're willing to take on credit risk. A guaranteed 7% with zero risk is a serious rate of return. And here's one more thing the spreadsheet doesn't show. Taxes. When your investments grow and you eventually sell, you pay capital gains taxes. Even at favorable long-term rates, that's still money going to the IRS. But when you pay down your mortgage, you pay nothing on the interest you didn't have to pay. The $142,000 you saved in interest doesn't appear anywhere on your tax return. You just keep it. The spreadsheet says investing wins by $506,000, but the spreadsheet assumed a smooth 9% every year. In the real world, with sequence risk, taxes, and the psychological reality of watching your account drop 40% in a bad year, while you still have a huge mortgage payment, the gap narrows considerably. So we have a genuine tension here. Investing gives you more total wealth in the model, but with real risk and real volatility. Prepaying gives you a guaranteed return and eliminates the mortgage faster, but leaves more on the table according to the math. What's the actual answer? This is where the F-squared rule comes in, the Freedom Fund rule, and it's simpler than you might expect. You do both. I know, you wanted a definitive answer. But here's the truth that most financial content won't say out loud. Personal finance is personal. The mathematically optimal answer might be to invest everything, but the mathematically optimal answer doesn't factor in how you actually sleep at night. It doesn't factor in what happens to your decision-making when the market drops 30% and you still have $400,000 left on your mortgage. Money is not just spreadsheets. It's stress. It's the story you tell yourself. It's whether you can sit at dinner with your family and not have a knot in your stomach. Some people sleep perfectly fine knowing their money is in the market, even when it's volatile. The ups and downs don't bother them. Other people cannot sleep at all knowing they're carrying a 6-figure debt, even if that debt is a mortgage at a reasonable rate. Neither of these people is making a mistake. They just have different relationships with money and risk. The F-squared rule says, split your extra money between both goals. The exact split is yours to decide, but here are the frameworks that actually give you guidance. The 60-40 split puts 60% toward investing and 40% toward prepayment. This leans toward wealth building while still making meaningful progress on the debt. The 50-50 split is the balanced version, half and half. You're building wealth and reducing debt at the same time, moving both forward simultaneously. The age-based split makes sense for a lot of people. If you're younger, something like 70% investing and 30% prepayment leans into the power of compound growth while you have time. As you get closer to retirement, you flip it. 30% investing, 70% prepayment, because eliminating the mortgage before you stop working reduces the income you need in retirement. And then there's my personal favorite, the interest rate rule. Here's how it works. If your mortgage interest rate is above 8%, you should probably prioritize prepayment. The guaranteed return is genuinely competitive with what you'd expect from the market after accounting for risk. If your rate is below 4%, you should probably prioritize investing. The guaranteed return is low enough that the expected spread in your favor from the market justifies the risk. And if your rate is between 4% and 8%, which is where most people are right now, you do both. The exact split is yours to determine based on your personal comfort with debt and volatility. Let's see what the balanced approach actually produces with our $1,000 example. You split the extra $1,000 evenly. $500 per month goes toward extra mortgage principal. $500 per month goes into the market. Both amounts grow by 3% annually. With the prepayment piece, your mortgage goes from 30 years down to about 21 years. You save roughly $198,000 in total interest. You spent about $119,000 in extra payments to get there, so your net savings is approximately $79,000. With the investment piece, your $500 per month, growing at 3% annually, compounds at 9% returns over 29 years to approximately $842,000. Now, here's the part that matters. When you pay off the mortgage at year 21, you free up your entire monthly obligation, the original $3,327 plus the $500 you were investing. That's about $3,827 per month that you can now throw entirely into the market. You've got 96 months remaining, 8 years until the original 30-year mark. At 9% returns, that $3,827 per month grows to approximately $462,000. Your total, $842,000 plus $462,000 plus $79,000 equals $1,383,000. Let's put on all three scenarios side by side. Invest only $1,834,000. F squared rule at 50-50, $1,383,000. Prepay, then invest. $1,328,000. The 50-50 split lands almost exactly in the middle. You end up with about $450,000 less than pure investing. But you paid off your house 9 years early. You got to experience what it feels like to live without a mortgage payment while you're still in your 40s or early 50s. And you didn't spend 29 years lying awake watching the market swing up and down while carrying a massive debt. Whether that trade-off is worth $450,000 is something only you can answer. There are situations where the math tips so heavily toward prepayment that it's not really a debate. High interest debt first, always. If you have any loans above 10%, credit cards, personal loans, certain car loans, stop everything and pay those off before you invest a single dollar. You are not going to consistently beat 18% or 24% credit card interest in the stock market. That's not happening. Pay it off. If you're within 10 years of retirement, having a paid off house dramatically changes your math. You're not just reducing the principal and interest, you're reducing the monthly income you need to cover your costs in retirement. That has real value that doesn't show up cleanly in investment return comparisons. If your job feels unstable, if your industry is shaky, if layoffs are happening around you, reducing your monthly obligations might be worth more than building wealth right now. You cannot make a mortgage payment with unrealized stock gains. And if carrying this debt genuinely causes you stress that affects your health, your relationships, your sleep, pay it off. The psychological return of that peace of mind might be worth more than any market returns the spreadsheet is promising you. On the other side, there are situations where investing clearly wins. If you refinance to 3% or 3.5% during 2020 or 2021, you have something close to free money after inflation. Invest everything extra that you can. The guaranteed return on prepayment is so low that the expected market return, even accounting for risk, makes investing the clear choice. If you don't have a 6 to 12 month emergency fund yet, build that before you prepay anything. Liquidity matters. Your home equity can't cover an unexpected expense without selling the house or taking out a loan. Cash can. If your employer offers a 401k match and you're not taking all of it, do that before anything else. A 100% employer match is a 100% guaranteed immediate return. Nothing in this video touches that. And if you're in your 20s or early 30s, time in the market is genuinely your superpower. The difference between starting to invest at 25 versus 35 is enormous. We're talking hundreds of thousands of dollars over a lifetime from just that one timing difference. Compound growth is patient, but it requires time to do what it does. You know what I realized while putting this together? The spreadsheet doesn't actually matter as much as I thought it would going in. I spent a lot of time building these models, checking the formulas, making sure the numbers were accurate, and the math is important. Don't get me wrong, but the math is not the answer. Here's what I mean. two people can look at the exact same mortgage, the exact same interest rate, the exact same numbers, and tell themselves completely different stories about what it means. One person looks at their mortgage and thinks, this is a stepping stone. I'm building towards something. The debt is manageable and the market is going to compound this money for decades. They sleep fine. The other person looks at the exact same mortgage and thinks, this is a weight around my neck. I owe more than most people earn in a decade. Every month I'm paying the bank first. They can't sleep. Same house, same numbers. Completely different experience. And here's the thing about the person who can't sleep. The optimal mathematical strategy of investing everything is worthless to them if it makes them miserable for 30 years. A financial strategy you can't stick to emotionally isn't actually a better strategy, even if the spreadsheet says it is. Let me make this practical. Here's exactly what to do after you finish this video. First, pull up your mortgage statement and look at your actual interest rate, your remaining balance, and your monthly payment. Run it through an amortization calculator so you can see exactly how much of your payment right now is going to interest versus principal. The numbers will surprise you. Second, figure out honestly how much extra you can put toward either investing or prepayment each month. Not an aspirational number, a real number that you'll actually hit consistently without feeling squeezed. Third, decide your split based on your situation. Use the interest rate rule as a starting point. Above 8%, weight toward prepayment. Below 4%, weight toward investing. Between 4% and 8%, which is where most people are right now, start at 50-50 and adjust based on how you actually feel about debt and risk. Fourth, automate everything. Set up automatic extra principal payments with your mortgage servicer. Set up automatic investments into a low-cost index fund. Make the right behavior happen without requiring you to decide every month. Fifth, revisit it once a year. Not every month, not every time the market moves, once a year. Did you get a significant raise? Increase the amounts. Did your mortgage balance drop to a threshold that feels more manageable? Maybe shift slightly more toward investing. Did the market have a brutal year? Maybe shift slightly more toward prepayment. This is not a decision you lock in forever. So let's bring this home. You're lying in bed, phone in hand, you saw your college roommate's investment post and your high school friend's mortgage payoff photo, and you've got this real decision in front of you. What to do with that extra $1,000 a month? Here's what I want you to walk away knowing. Investing only. $1.83 million over 30 years. Strong, powerful, and comes with sequence of returns risk, market volatility, and 30 years of carrying the debt. Prepaying then investing, $1.33 million over 30 years. Less total wealth, but a guaranteed 7% return on every extra dollar and a mortgage that disappears in 16 years. The F-squared rule at 50-50, $1.38 million over 30 years. Mortgage gone at year 21 and a balance between building wealth and eliminating debt. None of these is wrong. The right one is the one that matches what you actually want from your financial life, and the one you'll actually stick to over decades. The person with 542 likes who paid off their house isn't wrong. The person with 378 likes building their portfolio isn't wrong either. They just optimized for different things, and both of them are doing it intentionally. That's the whole point. Do it intentionally, with real numbers, based on what actually matters to you. If this video changed how you're thinking about this, hit that like button and subscribe because this is what I do every week. Drop a comment and tell me, what's your split going to be? And what does financial freedom mean to you? I read every single one. See you in the next one.